Hey everyone, I'm Paul Shannon, experienced LP and host of today's Deal Review. At Passive Pockets, our mission is to equip you with the tools and insights to confidently step into passive investing as a limited partner. And one of the best ways to do that is to review deal after deal after deal and understand what separates a great investment from a bad one. So today we're kicking off something special. It's a panel of experienced LPs that will review a deal from sponsor RSN Property Group and Monday Properties called the Villas at Princeton Lake. It's a 210-unit core plus multifamily property in the Atlanta, Georgia MSA. So here's the format. RSN and Monday Properties will pitch their deal. Our panel will ask tough questions. We'll then say goodbye to the sponsor group, and we'll wrap up with an LP-only discussion to break it all down. We're going to do a lot more of these deal reviews. This is just the beginning, so we'd love your feedback. Share your thoughts in the comments below. Before we kick off the deal, a quick intro for all that are on the call. Today we have Chris Wiederhold and Ben Gray from RSN Group here. How are you both doing today?
Doing great.
Doing good. Thank you.
Good to hear, guys. We also have Ryan Stieg and Chad Ackerman, experienced LPs, to help today and weigh in. What's up, guys?
Hey, Paul. Thanks for hosting.
Hey, Paul.
Awesome. All right. Without further ado, let's put Ben and Chris on the spot. Guys, if you would just give us a quick rundown of Monday and RSN, who you are, kind of the track records, and then let's jump into the meat and bones of the deal.
We've got that in the presentation, but let's jump to it now and tell you that RSN is a multifamily investment firm that has been 100% focused on our niche of value add and to a lesser extent core plus investments over the last 10 years. It's all we do. It's the same business plan that we're repeating again and again. It's a little boring, but we're very good at it. You know, we'll get into a bit more in the presentation here, but with that, I'll pass to Chris from Monday Properties.
My name is Chris Wiederhold, and I'm the VP of Multifamily Acquisitions at Monday Properties. I've worked in multifamily acquisitions for over a decade. That includes the purchase of about 12,000 units and $1.4 billion in deal value. And I've had the opportunity to work on properties across the risk spectrum from in-place cash flow to value add. And then just a quick high level on Monday. Monday was founded in 2002 by Anthony Westreich, and we have offices in New York, DC, and Charleston. Since that time, the firm's transacted on over $16 billion in deal value. And as it sits right now, Monday's done about 6,500 multifamily units through development, acquisition, or currently in our development pipeline. And as it sits now, we're focused on purchasing multifamily value add properties in the Southeast at a substantial discount to replacement cost. I think this deal fits really well into that box.
Outstanding. Thanks for the introduction, guys. If you wouldn't mind, let's start talking about the villas at Princeton Lakes. How did you guys source the deal? What did you like about it? And let's just talk about the plan.
So this came to us off market through a broker that I've known really since I've been in the business. I have a good relationship with him, and I was just having a casual conversation with him on the phone about the market, and this deal just had fallen out of contract. He was bummed about it, obviously. He told me about the deal. It sounded interesting at a high level. So he sent me the documents, the T12 and the rent roll, and underwrote it quickly. It looked interesting. Got out there quickly for a tour to Atlanta, and we were able to tie it up after a buyer interview call with the seller, which went pretty well, obviously. So we like that we got it off market. We think we got it a little bit less than the previous buyer had it under contract. And then I think rates are just a little bit better than they were when this deal was marketed. So there's a few things that are in our favor as it relates to the basis.
So Ben, we're kind of asking a lot here to summarize this entire deal in 15 minutes. For those that are interested beyond this call, there are additional resources on the Passive Pocket site. But can you do your best to kind of give us the deal synopsis, the key metrics, the business plan, debt financing, et cetera, in the next 15 minutes or so?
Absolutely. We've got a presentation here, so we're going to go through it as quickly as we can, and I will skip some of the parts that we have already covered or I know we're going to cover. And I will take it away with a very quick flash of the disclaimer. We're not going to leave this on the screen for too long, but download the prospectus, read this in full. And we're going to get into the webinar, starting with the RSN track record. We've been owning and operating assets across the US for 10 years. We're coming up on $1 billion in acquisitions. And like I said before, we're 100% focused on acquiring existing multifamily assets in growth markets. And our average IRR on our full cycle deals is just over 23%. And that's before we consider tax benefits like depreciation, long-term capital gains rates. And briefly, I'm going to talk about why we love this deal. Briefly, what I will say as well is we are closing on this deal in 2 weeks. So if you like this deal, you're going to need to move really quickly, sign the offering docs, fund your wire, and we might be able to sneak in 1 or 2 people after the closing, but you definitely want to move quick if you like this, and we'll be happy to help you accelerate your due diligence. For those of you who do think this is a great opportunity, again, we will help you accelerate that due diligence. This deal was brought to us off market from Monday Properties. We'll dive into their background in a minute, but we're going to talk briefly about why we love this asset, As we sort of mentioned before, it was under contract for well above our purchase price, but it fell through for reasons on the buyer's side. And Monday Properties leveraged its deep network and expertise to connect with the seller and secure the acquisition at a discount to the market and previous offers. In fact, this is a great basis play at about 30% discount compared to similar vintage assets that have sold recently over the last year or two. And the seller hasn't significantly improved the asset, but they've done a great job of maintaining it, spending a modest $1.8 million since 2020. Now, the biggest thing that we love about this deal is not necessarily the deal itself per se, but the tax benefits on this are really, really impressive. We might be looking at passive losses as much as 80% flowing through to investors on their K1s. So if you invest $100,000, you very well could be seeing $80,000 in passive losses flowing through to you. So this is a great opportunity at the end of the year to, capitalize on those tax benefits. And the other thing that we love about this deal is that it's a core plus asset, but it has value add returns. Our business plan isn't our typical higher risk, higher reward value add business plan. This is a core plus asset and business plan, but the return profile, again, is nearer the end of the typical value add deal. It's your classic asymmetric risk reward opportunity that investors love. And look, this deal is just oozing potential. But more than that, the multifamily market is in a really unique spot. We've been taking the position as RSN that in the years looking back on this, investors are going to realize this was a generational buying opportunity. Prices for multifamily apartments have fallen more today than they have during the 2008 financial crisis. And there's just huge upside projected in the multifamily market. And we're really bullish on this and really excited to be ramping up our acquisitions to make the most of this. And don't just take our word for it. The big players in the market, Blackstone, KKR, and other groups are actively making this bet as well. So we think that this is a generational buying opportunity is the words that we use for it. And it's not going to be here for long. This might last a year. It might last 2 years. We're not sure, but we're jumping in with both feet to make the most of this right now. So let's talk about the RSN team and our investment approach. We're kind of repeating ourselves here, but look, we've been around for 10 years. All we do is value add multifamily. That's really us in a nutshell. Look, here's the team. I'll go over it briefly. We've got my business partner and longtime good friend, Reed Goosens, CEO and founder. He's not able to join us today, but he is ultimately responsible for everything in the business with a focus on the acquisitions and asset management side of the business. You've got myself. I'm responsible for all of our business operations and everything to do with equity. And we have a great supporting team that can help with everything and anything so that we're getting the most out of every deal that we acquire. And then we have Monday Properties here. And Chris, I think you've given a brief intro, but jump in and maybe give it another 10, 30 seconds.
Yeah, absolutely. Monday Properties, I would say historically has invested more in office and has also developed in South Carolina apartments. And I think recently the firm has ventured into buying multifamily as more of a focus, which is where I came in. I actually came on board in June to build out a multifamily value add platform. And that's really what we're doing here. And part of the reason we're partnering with RSN is that we think it's a great entry point for multifamily. And we think RSN is a great partner to scale a platform in that deal profile. But yeah, again, I sit in Charleston, South Carolina. We have a small office in Charleston. We have a bigger office in DC where we have about 5 million square feet of office. And then we have a sizable office in New York City as well. And the firm's been around for over 2 decades with some pretty meaningful roots dating back to as far back as the 50s. Yeah, that's kind of the quick high level on Monday. And there's some key stats down there. I mentioned the 6,500 multifamily units. And I think that speaks to the shift that Monday's looking to get into the multifamily side.
So we're going to be talking about the property overview next. Chris, why don't you give a very brief overview of the property and then we'll jump into the next section here.
Yeah, absolutely. It's 210 units built in 04. Very clean deal. The seller spent almost $2 million since 2020. You've got brick and hardy siding, washer dryer connections in all the units, 9-foot ceilings. So very good physical product. There's 5 buildings and 1 clubhouse. So in terms of just understanding the deal, it's very easy. The layout is comprehensible. You've got a good mix of 1, 2s, and 3s. You've got among the biggest units in the competitive set at about 1158 average square footage. So yeah, and it's got more modern physical plant relative to deals that might be 90s or older, which we like. Just in terms of the renovations, we think there's some modest upside just in some light finish upgrades to the units.
Thanks so much. Look, let's jump into an overview of the Atlanta market, which we absolutely love. So look, Atlanta's a big city, got over 6 million residents. It's the 6th largest MSA in the USA, and it has incredibly strong fundamentals underpinning it as an exceptional growth market for real estate. So let's talk about population growth, which is one of the biggest drivers of any real estate market. And according to the latest data from the US Census, the Atlanta MSA is the sixth largest metro area in the US and one of the fastest growing. It's been adding 900,000 new residents since 2010, which is a 17.5% population increase. And going forward, it's expected to experience a population increase of 20 to 25% by 2030 and up to almost 8 million by 2050. So this isn't a flash in the pan, this is a long-term trend. And of course, the other big factor driving real estate markets is obviously the GDP and the economy. And Atlanta is, a powerhouse in that department as well. So it's got a $500 billion GDP as of 2023. And the rate of growth of that GDP since around about 2010 has been faster than other big metros like Dallas, Denver, Charlotte, etc. So it's really, really dominant in that growth. And if you look at US future GDP growth, it's going to be around about 2%. Georgia is going to be more than 2.5 times that at 5%. So really strong GDP growth, and job growth is pretty impressive as well. Every city had the COVID dip, but depending on the stats that you're looking at, it's about 75,000 new jobs being created each and every year in Atlanta, which is obviously fantastic. And unemployment sits at about 4%, which is a little bit less than the US average. Now, getting into the investment overview, Chris, again, let's just roll with this. I'm gonna throw a bit of the business plan discussion to you. You know it like the back of your hand. Let's keep this moving.
Yeah, absolutely. So I talked about the capital is minimal deferred, nice, clean, physical deal. The landscaping looks great. It's a gated community, which residents like. You're right off just locationally Fairburn Road and Cascade Road, where there's a Chick-fil-A, Starbucks, Publix. So good access to retail and restaurants right there. In terms of the business plan, we're going to go in and do a backsplash in the units. We're going to install some microwaves, repaint the cabinets, add more modern hardware. We're really looking at the comps that rent for more and seeing what they have that we don't have. And those finishes are representative of what's missing. So we're really just trying to match the competitive set to better compete with them. And then we're going to replace 4 of the 5 roofs. They're original, so they're about 20 years old. You're coming up on the useful life. And we think that it makes sense to kind of take care of the roofs now because on our exit, we don't want it to be a concern for the next buyer that they're talking about the roofs as a deferred item. We'd rather have them focusing their dollars on the interiors. And part of that is we think that this exit for the next buyer, the value add will be hard surfaces. And we actually plan to test maybe 10 to 15 quartz or granite countertops just to see market demand for the hard surfaces in this area. But as of right now, we're not fully contemplating, like a systematic hard counter value add. So that's just kind of the quick high level on the business plan.
Awesome. And of course, it's all underpinned by data and stats. So you can see here that, we've got a big opportunity to bring rents up to market and capture that value and, really make this investment great for our investors out there. Even though interest rates are, starting a cutting cycle with the Fed, we're going to be locking in fixed rate debt. We're being very conservative in all of our assumptions on this deal. If we can outperform our assumptions and get investors a higher return, then great. But we're not one of those groups, and neither is Monday, to make outsized, ridiculous assumptions and bake that into a business plan and bake that into the returns that investors get. We really want to protect our investors and our track record, and better to underpromise and overdeliver. And I'll let you speak to the sales comps here, Chris.
Yeah, absolutely. So we have some comps here of similar vintage type deals that are proximate to this asset, and I think the comps that I would point out to are Reserve at Redwine. That traded for about $260 a door, $250 a foot. All the while, they're a newer deal, right? They're about 10 years newer. But just in talking to the manager at Villas of Princeton Lakes, he said that this is a very good comp where residents are also kind of looking to rent when they're seeking a unit. And then Windsor Vinings and Southwood Vista are also great comps. Southwood Vista is the closest comp. It's about 3 to 4 miles away. While Windsor Vinings and Redwine are, I think, about 5 or 6 miles away. So they're just a bit farther away. And you got our purchase price per unit of $175 a door, about $150 a unit, I think looks pretty good relative to these sales comps. I think, that's part of the story of why you enter into this market is that you're buying 20, 30, 40% off pricing from 2 to 3 years ago. So, we think we're getting a really good basis at a very good discount to replacement costs, which is still around $260 a door, and especially for an asset of this size. These are bigger units.
Thanks. And what I'll add to that is, what the replacement cost really means to investors is that if another group comes in here and tries to do a development to put more multifamily units online, they're not going to be able to do them at the rents that we're talking about. They're going to have to do a Class A asset. They're going to have to set, $2,000, $3,000 rents. So we've got a lot of protection for the types of product that we're putting onto the market from those new developments because those replacement costs are so high. We'll briefly touch on the CapEx budget here. We've got about 1.25 million going into this property. Like we said, we're not going to be doing the typical RSN, fully renovate these units that really, really need a facelift. This property is already in really good shape. So we're just doing a little bit of an uplift, trying to get that $50, $100, $150 pop on all of the units. And we've got some plans to beautify the community, beyond that, update some of the amenities a little bit. But again, this property is gorgeous. It looks really good as it is. Chris, anything you want to add to that?
Yeah, no, I think to your point, we're going to do new rubber flooring in the fitness center. We're going to fix up some of the pool, just get new pool furniture, refresh some of the items that, maybe the seller hadn't addressed yet. And just kind of round it out to better compete with the comps, which are renting for a bit more. And we think that we'll just do really some tweaks in the units, like I mentioned, specifically a backsplash. All the comps that rent for more have one. So obviously that seems to be important to renters. And you can lose a lease over something as small as not having a microwave, and the units here don't have those. And I know it sounds kind of funny, but you want to make sure that you are competitive with the comps. So we'll make sure that this property is as competitive as it can be.
And we'll briefly talk about the debt here, and saying we're obtaining a non-recourse 65% loan to purchase price agency loan. That's fixed rate debt, and we're going to be buying down that rate to about 5.4 for the entire 5-year hold. And Chris and I checked, and yesterday it looks like we're still going to be able to achieve this rate. So we're in good shape, even despite the recent moves in the interest rate market. And what this means is, we're buying this asset at a 6.23 cap, and with interest rates in the mid-5, we're going to have cash flow from day one without even having to lift a finger before we even begin these renovations. So, it's really great to be able to be buying good assets in growing areas with positive leverage, really reducing the risk and just, giving us opportunity for upside. And then in terms of an exit strategy, we've got a lot of confidence in our business plan, and we do have the opportunity to add a supplemental loan anywhere within the first 36 months, should the asset value support that. Again, we haven't underwritten to that, but that's the ace up the sleeve and one of the many benefits of getting an agency loan. With that, we'll jump to the equity, which is what all of our investors really care about. So at RSN, we always offer 3 equity tiers, or almost always. In this case, Class A, our pure cash flow class, is already fully subscribed. So I'm going to skip past that and talk about Class B and C. So Class B, effectively, you're doubling your money in 5 years if we hit our projections. Cash flow is a little bit light in the first year and the second year, but then it really jumps up after that. And this is, your common equity class. So it's very similar to Class C, which is slightly better economics, but you've got to make a larger investment of $500,000. Otherwise, it's exactly the same as Class B. The cash flow is a tiny bit higher at the end for a couple of reasons we can get into in Q&A if anyone wants to dive into that. And guys, with that, we'll summarize and say, look, this is a gorgeous asset. It's a great basis play. The tax benefits are huge. Again, we're talking about 80% of your investment coming back as passive losses. If you're a real estate professional in the eyes of the IRS, you can deduct that from your active ordinary W-2 income, which is a huge benefit. And for other investors who don't meet that criteria, you can still benefit from these deductions significantly. Absolutely speak with your accountant, speak with your CPA. And there's more to it than that, Chris. Anything you want to wrap with before we jump into some hard-hitting Q&A from the big team here?
Yeah. This is a great deal at a good basis in a major market in the Southeast that's growing. You have tons of people moving to Atlanta because of the job growth and the cost of living. And we didn't touch on this, but this deal has very good affordability, and it's qualifying for among the best pricing on the agency grids because of that inherent affordability in terms of the rent levels relative to area income. So we're buying a deal at a good basis with some light value add upside. We can touch on this in the Q&A too. Is the supply and demand imbalance is projected to be significant, where supply of multifamily is going to drop off next year and the years after. So something to keep an eye on as it relates to occupancies and rent growth, because obviously with less supply and continued demand, you should see pressure on rents and occupancy. So I'll leave it with that.
Yeah, this has been great, guys. Chris, Ben, thanks for the brief overview. There's a lot of actionable content in there for investors to chew on. So beautiful looking property and obviously a great metro area. Let's jump into the Q&A. I'm sure Chad and Ryan have a lot of questions to ask. I know I do as well. The first thing is a good transition, Chris, to your last point there on supply and demand. It seems as though markets that have strong rent growth are ones that have low supply, and vice versa. Ones that have a lot of deliveries that are not being absorbed are having issues with raising rents, or maybe even their rent growth is negative. What is the local story there in the Atlanta MSA and in this this zip code specifically, as far as deliveries coming to market and what the absorption level looks like? And is that going to impact year one as far as your rent growth trajectory?
Yeah. So if you look at Atlanta as the metro overall, it's about 20 to 22,000 units have been delivered each of the past 2 years, 2023 and 2024. Those are among record levels of supply. I mean, the market's really been absorbing those units. Then if you get down to the micro level, right, like this property, it's in West Atlanta. So you're in an area where the level of rents do not justify new supply, right? So like the rents at this property are $136. We're looking to bring them towards like $150. And I mean, at the most, you can get like $1.60, maybe $1.70 in this submarket, and you really need at least $1.75 to justify new construction. And obviously, you want that higher as a developer. So like developers aren't really pouring into this submarket unless they're getting some sort of tax incentive, like from an affordability component. So that's one thing to keep in mind as you look at, like, you're right, like Charlotte, Raleigh, Nashville, these markets that have good growth but a lot of supply. And in Atlanta too, there's supply in Atlanta, right? But you want to look at these submarkets where the rents really aren't high enough to justify new construction. So you benefit from the growth in Atlanta, but you're not in like the core areas where the new supply is being developed.
Why don't we just do this like a round robin style, guys? Chad, why don't you head next, and then Ryan, and we'll just keep circling around.
Yeah, I can kind of spin off of the Atlanta discussion that was going on. In your materials, I saw, Ben, your group has really kind of been focused in Texas and maybe South Carolina a lot. Chris, it sounds like you were more up in the Northeast. Sounds like you have a lot of wealth of knowledge in Atlanta, but can you talk about your experience in Atlanta? Have there been properties that you've invested in and bought and worked with that kind of help with the track record locally for this market? It sounds like you got a lot of great detail about Atlanta, but what's the track record look like as well?
Sure. Well, I can jump in a little bit on that. And I mean, we don't have a huge track record in Atlanta as RSN, but we've been watching it for a very long time. And we have owned an asset there for the best part of a couple of years. And that was deliberately to get a foothold in the market. And with that, we get to, work with our GC. We get to work with, different service representatives and get a feel for the city, get a feel for what's going on. It gives us an excuse to be looking at the stats in Atlanta every day. So this isn't our first foray in there. We've been really actively looking at this for a long time, prepping, and getting that first property to get our foothold in there. And that's, the genesis of RSN getting into the Atlanta market. And I'll let Chris speak for Monday.
Yeah, so actually, my experience, I've done over 60 deals, 12,000 units. Most of them are actually in the Southeast, Chad. And then I've done some in the Midwest. I actually haven't done any deals in the Northeast. I'm actually from the Northeast. I just ended up doing multifamily acquisitions really in the South. So out of those 60 deals, I've done 2 in Atlanta. Bought a deal in 2019 for about $200 a door, and we sold it in 2021 for about $280 a door. So that was a good outcome for investors there. And then back in 2017, I bought a deal in Southeast Atlanta for about $100 a door, 2000s product. It was a very good basis, and I believe that deal is still held by that ownership group, and it's cash flowing very well. But like those 2 deals, I had good experiences with those assets. They beat the business plans, which was great. And we used, on both of those deals, I used Stonemark, who we're using to manage villas. And their HQ is 20 minutes from the property. And the key professionals there have been doing this for 30 years. So I have good faith in them to execute on this.
Oh, that's great. Appreciate the background.
I'll kind of tag on to that too. So you've got Stonemark, RSN, and Monday. It sounds like Monday is kind of going to be the lead operator in this particular deal. Can you kind of talk a little bit about what role each of you will play in this particular deal? Sure.
I'll jump in first and then I'll pass it over to Chris. The first thing I'll say is that this is a true JV partnership. So, RSN aren't coming in as, a capital raise or anything, funky like that. It is a true JV partnership. So we have major decision rights and, we're collaborating heavily as we do, behind the scenes on everything and anything about this deal, sharing pursuit costs, et cetera, et cetera. So absolutely Monday are going to be in the driver's seat. They're going to be making the day-to-day decisions and working with the property manager. But we see this as a partnership of many where sometimes we'll be looking after the property and sometimes Monday will. And in this case, we're very excited to have Monday take the hassle of asset management off our hands. And Chris, maybe you want to add to that.
I'll be involved with the asset management execution, working hand in hand with a counterpart in the asset management side, my counterpart, this person named Kenny. And so Kenny's like our senior vice president of asset management. He'll be overseeing the execution. We also have 2 associates that will be supporting Kenny on the asset management side. So, we'll be paying very close attention to the assets, speaking with the regional manager, the property manager, reviewing weekly reports, weekly calls, monthly reporting, making sure the financials are tracking well with budget and underwrite. We will keep a good pulse on the deal and see where things are going well and where things aren't going as well, and make tweaks to make those things improve.
My next question is twofold, really. So I'll ask both questions at the same time because they're both related to the share class structure. So the A shares you guys mentioned, the pref equity layer, is sold out. First question is that a institutional player, or is that made up of retail investors and it was just popular and it's already filled out? The second question is around the B and C shares, the promote structure being very favorable for the LPs at 90-10 for B shares and 95-5 for C shares. That's unusually high in favor of the LPs. So, from what we've heard as LPs, it's difficult to keep the lights on potentially if you're not making that upside on the promote. In this case, with a larger asset, there's some money to be had, but there's some fees and such where you're making money on the front end and asset management and construction management and such, which are fairly reasonable and current with industry standards. But why such a aggressive promote structure for B and C share?
Sure. And I'll speak to that and pass to Chris again. So there is a double promote in this. So it is 75-25 at the deal level. And then there is a small promote that's taking place on the RSN side, partially so that we can offer the B and C shares that we always do. And to answer your other question on the Class A, that is an institutional group that's come along and taken that from the get-go. So I'll happy to answer more questions on that, but Chris, I'll pass to you to add further color.
Yeah, no, we had a large institutional group come in. They liked the deal, and they took that slug out from the get-go. So, I think, obviously that's a good thing. They liked the deal. They went down with me for a good property tour and comp visit. So, I think, we're excited about getting equity investors into the B and C shares because they share in the upside on the back end.
Absolutely. And one thing I will add before we move on is one of the key benefits of bringing in this institutional group to take in the Class A shares. Typically on our RSN deals, we offer tax benefits to our Class A investors, but that isn't the structure that we've agreed with the pref equity group on this one. So that is part of the reason why we've been able to structure it to maximize those tax benefits for our Class B and Class C investors to, again, get that 80% thereabout passive losses flowing down to them.
So with this being, I believe it's agency debt, correct?
Yep.
This would be soft pref then, where they don't have control rights or any takeover rights or provisions there.
So there are certain things where, it's like really kind of like bad boy or like significant events where there would be a changeover. But those are like, it would be if like the sponsor was doing, like a very, very bad job.
Negligence.
Yeah. Like bad boy type things. They're a group that we know well and that they're smart people and they're obviously interested in the deal if they're investing in such a way. So we're excited to have them on board.
I'll follow up with another question. Again, thank you for cramming so much information in a short period of time. I know this isn't your usual, so thank you for that. But along kind of that, this isn't your usual lines. You said typically you're a value add approach, Ben, and now you like this Core Plus. Seems like a good deal, good off-market deal and everything else. Is this part of your new strategy? Are you guys heading more to this Core Plus value or Core Plus market, or is this situational because of the off-market deal that you found?
I would say it's a little bit of both. So I'll speak candidly and off the cuff here. We have been a value add shop for a really long time. We're very good at it. It's what we know. It's what we love. And, it is our niche. It really comes down to the opportunity we see in the multifamily market in general. And we started, just running the numbers and saying, well, how many assets are we going to be able to acquire if we stick to our current buy box? And we realized that, we either had to, lower our standards, expand the value we're looking at, do all sorts of crazy things we weren't necessarily prepared to do. And so it just made a lot more sense to start looking at some of these Core Plus, light value add assets. And it somewhat came to us with Monday. Basically, we've been chatting with Monday for a long time. We've been talking about opportunities to partner. This deal came up as an option, and we ultimately said, hey, look, this is a good fit. Let's move forward. And, that's our first foray into the Core Plus world here, and hopefully the first of many. And we're not going to throw out the baby with the bathwater. You're still going to see really, I don't know what the word is, ugly 1980s value add assets that we're going to really make beautiful and really extract a lot of value out of.
Chris, does this fit more into Monday's model, this Core Plus? And again, this isn't a huge leap from value add to Core Plus, but LPs, we always get skittish when we start to see this the first time. This is unique. This is different than what we normally do. So just curious to get more background on it.
Yeah, I came on board to Monday in June, and I come from a pretty diverse background, mostly syndications, raising capital from friends and family, family offices, high net worth individuals, just for context. And I bought deals like this. I bought 70s, 80s product, like Ben mentioned. At Monday, we think that there's a really good opportunity here to buy this type of product, which 2 years ago was trading well north of 200 a door, at a significant discount to replacement cost. It's well occupied, it's cash flowing, you've got good debt service coverage, you've got Freddie or Fannie agency debt. We're generally not buying deals that are older than 90s, but we're opportunistic as well. But we're really looking for these 90s or newer deals with some sort of upside like this. I mean, if you look at this type of upside, it's relatively a moderate value add, right? And I didn't even mention this, but there's a lot of expense upside here, where the seller maybe is running some expenses higher than what we typically see. The other income is lower than market. The utility recapture is a bit low. So there's just some levers here to pull, which I think are generally considered lower hanging fruit type items that we like to see here. And it's not to say we wouldn't consider maybe more of a more meaningful value add. If the deal makes sense, if it pencils and has data backed assumptions, then we'll consider the deal. But I do think that this is pretty representative of what we're looking for in terms of the deal profile.
Can you guys talk a little bit about, and I love the sensitivity analysis that you have in the executive summary. That's very helpful. Can you talk a little bit about the exit cap rate projections and why you feel like that's kind of a sweet spot for where you feel that this property can get to on an exit? So
I pulled CoStar 2024 year-to-date deals along this profile. So deals that are greater than 100 units, 1990 to 2020 built, greater than $30 million deal value, and the average cap rate for those deals is a mid-5 cap. And I'm actively underwriting deals in the market in Charlotte, Raleigh, Atlanta, Tampa, Orlando, and deals are trading low to mid-5 caps. So we're buying this at an in-place high 5 cap. So we've got a mid-5 cap on the exit, which a lot of people are expecting cap rate compression over the next few years. I mean, and I think some would argue that 5.5 might be slightly aggressive. I think that we're seeing that in today's market, and this is considered a tougher market. So just based on the actual data that we're seeing, we're actually underwriting deals with T12s and rent rolls and market pricing with big brokerage shops that are marketing the deals. We're seeing low to mid 5 caps in today's market.
And I've got this sensitivity analysis since you brought it up that I'm going to share here. Okay, well, look, this is in the prospectus, so you can look at this in more detail and ask us questions. And I'm going to oversimplify a complicated, nuanced topic here and just make the point that, the sensitivity analysis here, on the left-hand side, it's the change in exit cap. And on the top here, it's the change in stabilized rent growth based on an average yearly rent growth over a 5-year hold. So we're trying to predict, what different scenarios might unfold in the marketplace and what that would ultimately result in for investors. So the downside case that this particular table models, with all the disclaimers in the world, you're looking at $87,000 coming back on your $100,000 investment, which is obviously a $13,000 hit that no one really wants to take. The $200,000 return coming back on $100,000 is what we're projecting here. Like we said, doubling your money in 5 years. But the upside projection, which granted I don't think we're going to hit, I don't think we're going to hit the downside one either, but the upside projection is obviously 350, which is huge. A lot of things are going to have to fall in our favor for that to happen. But the point I'm making here is the way this investment is structured is, again, asymmetric risk reward. You're looking at a very low downside in the case that it goes really, really bad, but a very high upside in the case that it goes really, really well. So, again, this comes with a lot of disclaimers, but it is a fundamental structure of this deal that, we think is really exciting.
Very good, gentlemen. Thank you so much. We're going to move into the third section of the recording with LP-only dialogue. So I just wanted to take the opportunity to thank Chris and Ben for joining us today. It's been really informative and very professionally done. So thank you guys.
We're super excited to see what Passive Pockets does for the community, does for the syndication world, does for multifamily, does for all the asset classes. We're really, really pumped to be a part of this. And hey, a couple of teething pains on this first presentation here, but we want to come back. We want to do more. Excited to see you again, Chad, Ryan, Paul. And as always, thanks, Chris.
Appreciate you guys. Thanks for having us on.
All right, not a bad first go round, Chad. Ryan, a lot of content there, mostly digestible, a lot of stuff in a short period of time, but they answered questions well. We threw some curveballs at them. Would love to just get your all's feedback on what you think of the deal and what questions you have that remain unanswered.
Yeah, I'm impressed that they could cram that much information in that short period of time. I know that's stressful, but the deal, these off-market deals always are sexy and always worth looking into and trying to understand the numbers. I thought you guys asked some great questions about exit cap rates and fee structures and so forth. I thought they had pretty good answers for them, but I'd want to do some more due diligence into the PPM to understand some more of those numbers just to be comfortable. But on the surface, it's a great looking offer that they found here.
Yeah, I thought they did a really good job of kind of giving us a bite-sized version of what they typically do in an hour. So I think if you're really looking at this deal, I think it's helpful to watch the webinar that Reed did that's on the website, to go through the full pitch deck, which they kind of did in a compressed timeline. And then I think with this, it's all kind of a good supplement to making an investment decision. But I think there's a lot to like about this. I thought Ben did a good job at the end of talking through the sensitivity analysis of the asymmetric return, right? They're projecting double your money in 5 years, but the downside is fairly mitigated. I think there's a lot to like about the Atlanta metro area and the economics in Atlanta. It sounds like the property is relatively a light lift. Oftentimes when you have two partners coming together, it can be a little difficult, but it sounds like these guys have been working together for a long time. So I think it's helpful to have two eyes on this from an operational standpoint too. So that can get a bit complicated, but I think they're working on a long-term relationship with a product that is a relatively light lift for both of them. So I think there's a lot to like about this. There's certainly more questions to ask that we didn't get to today in this short time frame, but there's a lot to like about this one.
I echo both your sentiment. I think that there's nothing particularly that stands out with this deal being like unbelievable, right? Core plus, MSA, like light value add. I think it's like a preservation of principal type play. If you were looking at it, like where does this fit into my portfolio? Maybe you've got some tax advantages that you can take advantage of with your specific situation if you're an LP considering this deal. What I really do like about it is, large units versus the comp set. That's an immediate sort of competitive advantage versus what's in the marketplace. Price per unit is reasonable, and there's some reason to believe that it can grow beyond where it is today. A decent going in cap rate at 6.23. I don't know the Atlanta market inside and out, but that seems pretty reasonable for a B plus type asset like this, core plus area, and a discount to replacement cost that's going to make for a high barrier to entry for others to come in and create a product similar to this without having to charge, substantially more for rents. So I like all those things. I think it's one of those deals where, again, preservation of principal is paramount. I don't think there's a downside scenario where you're going to lose a bunch of capital if you're an investor. At least on the surface, it doesn't look that way. Operationally, these guys are sophisticated, and I think that they can get it done. Stonemark, sounds like Monday Properties has a relationship there. Has used them before, and they've got 12,000 units under management in that MSA area, or the Southeast in general, I should say. So execution concern is not real high. I'd say, if the macro trends become favorable, this could really be a deal that performs well. And that's where I see a lot of deals like this out there in the marketplace where it's like, okay, I got to question whether it's worth it for me to put my capital at play here and be illiquid for the next 5 years and potentially earn a return that's sort of, marginal, let's say it's a 12% deal if it doesn't pan out to the numbers that they have in their spreadsheets. Are you being adequately compensated at, let's say, 12% versus what you get in the S&P 500, but also have the liquidity, right? Now, if we get substantial cap rate compression and things start to look more like 2021, this is going to be a gangbusters deal, and you can subscribe to the theory that this is a generational buying opportunity, but that's crystal ball stuff, right? We don't know if that stuff's going to happen, if it's going to come true. So we kind of have to go off what we have today. I guess what I do like about it is I don't see a super high risk of losing principal. Although if you look at the sensitivity analysis, you'll see that if we miss by a little bit on rent growth, or if the cap rate assumption is a little bit lower than it should be, they've got a going in cap rate on actuals of 6.23, and they're looking at selling to 5.5 now. I don't know if that's aggressive. It's certainly not that conservative in my book. So it's like, how is this deal going to actually perform? That's a good question. I think the macro has a lot to do with that, not necessarily just the operator.
No, I think that's fair. We're recording this on Halloween, and the spooky part of what we're dealing with these days still is the current state of the economy and the what ifs that go along with it of, is it worth the risk at this point in time? It sounds like there's a lot of great potential. The risk seems lighter than some of the deals that I've seen come across my desk anyway. But I think you bring up a lot of great points, Paul. That's for sure.
As it should be, the risk as it pertains to that part of your comment, being a core plus asset and a newer vintage, the risk should be lower. Is there anything that you guys that stood out to you that you didn't like about the deal?
I don't know. I mean, I always get leery of what you brought up of the high splits and a little on the higher side of fees. Not too bad, but I always get leery of anything that looks too good for the LP. It's can't be, it's too good to be true kind of thing. But nothing really jumped out that was egregiously red flag to me anyway, put it that way.
Yeah, I'd have to agree. I don't think that there's anything that jumps out. I think they did a good job of talking through the reasons for fixed debt. I mean, some people are saying, hey, we're in a point in the cycle where rates should come down, but they're going in with a fixed debt strategy. So the risk, as well as a relatively low LTV at 65%, is cash flowing from day one, which what hasn't been the case in a lot of deals. So I like that there's mitigated risk from a downside perspective. You talked through, Paul, a lot of the upside for things that they can do. There's room to get to market. But yeah, from a downside protection, I didn't see anything that really stood out to me as a large red flag. I think they're a little bit protected if you look in the executive summary from supply coming on. They've got a long runway before there's more supply coming to market in a market that sounds like it's short of supply right now anyway. So I think they've got some runway to get to executing their full business plan to get up to market rents, to mitigate some of the costs, to get rid of some of the bad debt that they talked about. But as far as a large red flag, I didn't see anything that jumped out at me so far.
I would agree, Ryan. I don't see any real red flags, but there's a couple tidbits that I want to dig more into if I were going to evaluate this deal at the next level. One was a question that I brought up during the call about the pref layer and just kind of understanding, who this institutional player is, what are the terms within that agreement. It's 65% loan to purchase price, but if you include the pref layer, it's more like 80%. So the leverage is a little bit high if you think about that pref layer being in a position ahead of common equity as far as priority of payment. So understanding who that group is and what sort of takeover control rights they have and what provisions there are in that agreement is helpful. And then, as always, I would just encourage LPs to ask for the underwriting, right? I mean, a lot of the stuff that's on the OM is output driven. So there's inputs that go into a spreadsheet that arrive at an output like IRR, equity multiple, cash on cash return. Where do those numbers come from? Most of us that will evaluate that deal at that level aren't from the Atlanta MSA, but there's a lot of resources out there. You can jump on the phone and contact people that are local to the area, kind of understand the market a little bit more and figure out if that's a realistic underwriting file that these assumptions are based off of. But all in all, really good. Just wanted to thank you guys for being on the call and all of us working and collaborating together to make this happen. I would just ask the listeners, what questions would you guys have? This is going to go on a forum. It should be right below this video where you can ask questions that you might have to the group or that we didn't address in our LP session here. And also join us next time on the Passive Pockets Deal Review. Thanks, everybody.
Thanks, Paul.
Thanks, Paul.